0.5%. So earnings a big focus for investors, but still to come on worldwide exchange. How has the greenback impacted earnings so far? We navigate the FX headwinds next. From American Express to Coca-Cola, as earnings season continues, one trend appears to be emerging, and that is FX headwinds. All this week, we have been speaking to CEOs and CFOs about the currency impact on their companies' results. Take a listen to what some of them had to say.
I think if you look at our results, you have to look at them on a constant currency basis, and they were very good in the second quarter. So our sales were up 6%, core operating income was up 6% on a constant currency basis, and we were able to show margin improvement of about 30 basis points.
The reality is that some of the drops you've seen in commodity prices are offset by the strong dollar. Many of the commodities are in dollars, and we have to also look at the currencies in many of the emerging markets. When the currencies weaken, for example, then you have to offset that with pricing. So it's not necessarily that these lower commodity prices go to the benefit of the consumer. You have to look at that very granularly by country. And what you will see is that taking the effects of the currencies and the lower prices, the overall effect for us is about flat.
For Syngenta, in the first half, the currency matter blew our top line $1.1 billion backward, and we're really pleased that we were able to offset all of that currency impact, save for $50 million were contained to that number on the back of a really strong sales performance.
So how much longer would the stronger dollar be a concern for some of these big multinationals? Well, David Pierce, director at GPS Capital Markets, joining me here in studio. David, a pleasure to have you on the show.
Thank you for having me here.
Absolutely. So does the dollar strengthen from here?
Yeah, I actually think it does. We're looking for the dollar to strengthen throughout the end of the year.
Is that just based on Fed policy or is something else?
It's a combination of things, really. You've got the Fed policy. Everybody is expecting to have an interest rate hike in the U.S. Over the next year, but then the economy is still doing really well in the United States. Despite what you have heard in the clip that you just played about a number of companies whose earnings are down because of the strong dollar. Despite that, the economy is still relatively strong in the U.S. Add to that the uncertainty we're seeing around the world right now. The U.S. dollar is still the go-to currency for people that are looking for a safe haven for their money.
You think it's a better safe haven bet than the Japanese yen?
Yeah, it is. And not that the Japanese yen is a horrible currency or that the Japanese yen is not doing well or Japan is not strong, but just the sheer size of the U.S. economy and the sheer size of the investment market in the United States versus what's available in Japan is stunningly different. And if everybody put the same amount of money into Japanese yen versus the U.S. dollar, it would really imbalance Japan.
Absolutely. They need that weaker currency to stimulate their economy.
They really do. And they like it. I mean, Japan is really happy where their currency is right now.
Absolutely.
You know, up in the 120s, 115 to 125, they're really happy with it because it stimulates their economic growth. It makes it more expensive for them to buy commodities, but they're, at the end of the day, they're an export country.
And that's why you've been seeing a rise in tourism, specifically European travelers going to Japan. Yeah. And speaking of Europe, I want to talk about Greece, of course, taking another step towards a bailout. You think that would strengthen the euro bull trade, but that doesn't seem to be the case.
Yeah, Greece is a continuing problem for the euro, and it is the problem is people are not really sure what they're going to get with Greece. Even if we go and they're able to get, an $80–85 billion bailout and are able to get the money that they need to continue to grow, people are just not convinced that the underlying economy in Greece is going to be able to support that. They're going to be able to pay those loans back, and that the people of Greece are going to be willing to step up to the plate and pay the taxes that are going to be required to support the government.
So do you think a Greek exit is still being priced into the euro-dollar trade?
I think that people are looking at a possible Greek exit, but I think that people are still a little bit uncertain about where the euro is going to end up. A year from now, are we going to see other countries that are going to want to look at possibly getting out? There's no certainty in the market right now that the euro is there, it's going to be there forever, and it'll never change. I think there's still a lot of uncertainty around the euro, And then there's also, combined to that, there's a lot of uncertainty about what's going on in the economies within the European Union as well. It's not just the euro, it is the actual underlying economies. If you look at the economy of Greece, they're not adding to the strength of the euro. If you look at the economy of Spain, they're not adding to the strength of the euro. They are dragging the euro down. And when you look at that, it's not just about the uncertainty of the euro itself as an entity or as a currency unit. It's about the economies that back that up.
Yeah, absolutely. Economic and political, of course, both factors being put into place here when looking at the euro-dollar trade. I also want to get your thoughts on the Aussie. Obviously, is seen as a liquid proxy for China trades. Manufacturing once again coming in lower than expected. How does that change your outlook on the Aussie dollar going forward?
The Aussie dollar is always been known as a commodity-based currency, and because they produce so much commodities, you know, gold, silver, you know, different metals and stuff in Australia, and they also are a huge supplier to China. A lot of their animal products and things like that all are shipped to China because there's a lot of demand, and they produce a lot of things like that. With what's going on in the Chinese economy, the stock market having huge swings over the last few weeks, demand from China being down, that really hurts the Australian economy. And when there's not money flowing into Australia, that's why we've seen the Australian dollar weaken so significantly over the last year. And I think that that's probably going to continue. We've got weak commodity prices, weak demand out of China. I think that's going to continue to add to a weaker Aussie dollar. Yeah,
that doesn't paint a really pretty picture. We're already looking at the Aussie dollar hitting a 6-year low. So definitely not a good day for the Aussie dollar. We're going to leave it there. David Pierce, Director of GPS Capital Markets. Have a great Friday.
Thank you so much.
Thank you for joining us.